Don't think bonds deserve a place in your portfolio? What if I could show you how to get twice the dividend yield on half the risk compared to stocks? Better still, what if adding a bond ETF to your portfolio along with stocks and real estate, you could have beat the market this year with less volatility? That is the power of bonds. They're not going to make you rich, but will protect your money and provide income when stocks fall apart. Even on higher interest rates this year, my favorite bond fund has provided a dividend yield more than twice what you get from stocks. In this video, I'll share the 5 best bond funds to watch right now and the one every investor should be buying. It's the 8th in our Just One Stock series. If you could only invest in one stock across different themes, which should it be? We're going to cover all the strategies here, from value to growth, tech stocks, and real estate, and by the end of the series, you'll have a portfolio of the very best stocks to buy. So join the community and watch each week for a new episode. Now, up until now, we've spent almost the entire series on stocks, and that's going to be the biggest part of your portfolio, but combining those with that bond fund and the real estate we talked about in our last video, and you get a higher return on less risk. Let's start with a few of the bond ETFs I'm watching before I show you what to look for in these, how to know which is the best for your portfolio, and how much to invest. Our first bond fund is the SPDR High Yield Bond ETF, ticker SPHY. And this is going to be one of the more riskier funds in the list, but with a great yield of 5.6%. The fund invests in nearly 2,000 individual bonds, all in that non-investment grade rating category that offers the highest yields. Here you've got a lot of the consumer companies, telecoms, and energy names, but no bonds is more than 1/3% of your portfolio. Now, because these are less highly rated companies in the credit rankings, okay, maybe a quick refresher on what bonds are and why these are so much safer than stocks. Bonds are a loan to the company. They pay interest twice a year and then return the loan value at the end of the bond's life. That means companies legally have to pay back their bonds plus that interest. Stockholders only get a return and dividends as long as the company can produce profits and stay in business. But bondholders have that higher right to the assets. The interest rate, or the yield on bonds, is largely determined by a company's credit rating, a scale of how financially stable the company's financials are and how likely it is to pay that debt back. A higher risk equals a lower rating and a higher interest rate on the bonds. Okay, back to the high yield bond ETF though. And because these are less highly rated companies in those credit ratings, the bond values are going to rise and fall a little bit more with the stock market and the economy. It's just as the economy weakens, it's more likely that more of those bonds are going to default. So you do see this one jump around a little bit more than some of those other bond funds. Now, that said, the volatility is still less than half the stock market. Here we see the standard deviation of almost 21% for stocks and just 8.8% for the SPHY fund. I won't go into the math behind the standard deviation because it's only interesting to the nerds like myself, but think of it as your sleep at night measure, how much an investment jumps around when stocks crash. For example, the S&P 500 has a tendency to rise or fall about 20% in any given year. That's great when stocks are rising, but not so much when they crash. By comparison, that high-yield bond ETF only rises or falls about 9% on average, much less volatile, and is able to produce that dividend yield almost 4 times what you get on stocks. That's an investment you just can't ignore. And you can see that lower volatility in the price chart as well. While the SPHY and the broader stock market have produced about the same return this year, that bond fund did it with a much smoother ride. You didn't have to watch your portfolio crash lower and wondering if you were still going to reach your goals. So the high yield bond ETF is going to be better for investors that can take a little bit more risk but still want that safety of bonds for a part of their portfolio. You'll get the higher dividend and protection from a crash. And I know what you're saying. I know bonds haven't lived up to that safety that they're supposed to provide this year, and a lot of investors are still skeptical. With the rising interest rates, bonds got slaughtered in the first half of the year. Here you see the core aggregate bond fund, ticker AGG, plunged 10% in just 6 months, unheard of for fixed income. In fact, it was the worst first half performance since 1788. But if you look back on that chart, bonds still protected your portfolio. Not only did the bond fund suffer half the losses compared to stocks, but it was a much smoother ride instead of crashing lower. And the 5 bond funds I'll highlight today did even better than that, outperforming while still paying more than twice the dividend yield at half the risk of stocks. Here we see the standard deviation for the stock market versus all 5 funds along with the dividend yields. With the one exception of one fund, all of them are less than half as volatile as the market for great protection and cash flow. Now I want to get back to our list, so I'll show you what to look for in these and how much to invest in bonds later in the video. The Van Eck Fallen Angel High Yield Bond ETF, ticker ANGL, is another with a little higher risk, but a strong 4.3% dividend and good potential upside. Now the fund invests in bonds that were issued at an investment grade rating, so a strong financial rating, but have been downgraded into that high yield category. Now, bonds usually get downgraded on like slightly weakening financials or if a company adds more debt, but 93% of the bonds in this fund are in those first two risk ratings, just below investment grade, so still fairly safe investments. And what happens when these fallen angels get downgraded, the price of the bond comes down, but they're still paying that same coupon, so the interest rate goes up. Since they're all still solid companies, the default rate is low, and this group of bonds has outperformed the broader high yield index in 11 of the last 15 years. The fund itself has produced an 8.4% annual return since 2012, which is really good for a bond fund, and pays that 4.3% dividend yield. The expense ratio is just 1/3%. And again, these are bonds of good sized companies like Sprint and Freeport-McMoRan. Almost 3/4 of the fund is in bonds of US companies, with the rest in developed nations, and it's also well diversified across sectors, with bonds from companies in 9 sectors. Now, because of that non-investment grade rating, this one also jumps around with the second riskiest of the funds that we'll look at today. The fund outperformed stocks in the first half of the year, but started to lag a little recently when the stocks made a comeback. Still though, the dividend yield has made up that difference. Next on our bond list is the iShares TIPS Bond ETF, ticker TIP, tracking by far the standout investment this year. TIPS stands for Treasury Inflation Protected Securities, so it's a bond issued by the US Treasury with the interest rate and value adjusted higher for inflation. That inflation protection has made these one of the best investments this year, and that TIPS Bond ETF pays a stellar 6.4% dividend yield. But that's not all. Because they're issued by the US Treasury, the payment on TIPS is guaranteed, and the interest is free from state and local taxes. Now, the bond fund doesn't have that guarantee, but since it's only holding those TIPS bonds, its assets are always going to be safe. Now, with that general rise in interest rates, the TIPS fund has suffered those losses seen in all bond funds, but you can see here it really protected your money during the worst of the stock crash. When the stocks in the S&P 500 were down 20% at that June low, the TIPS fund was down just 12% and still produced a 6% plus dividend. In fact, the volatility on the TIPS ETF is the lowest in the group and less than 1/3 of what you see in the stock market. For its dividend, low volatility, and that inflation protection, this could be the best bond fund in the group, but I like our last two funds for just a little better. Those last two bond funds include one with the highest upside potential and the other with the perfect balance of between risk and return. But I want to help you with what to look for in these, as well as how much to invest. Bond funds offer an easy and cheap way to invest in bonds, usually holding thousands of individual bonds in a single fund. Now, investing directly in each bond usually isn't cost effective for investors because you pay a commission on each bond and don't get the diversification you need. Now, the biggest question you need to answer, though, is what kind of bonds do you want and what level of protection you need? Just like stock funds, there are bond funds for every type of fixed income investment, from the safest government treasuries to higher yielding and higher risk junk bonds. For most investors, going with a total bond market fund is going to give you a little bit of everything to balance that risk, return, and the yield. Now, how much money you invest in a bond fund really depends on how much safety you want from a crash in stocks. For example, someone with 5 years to retirement needs much more portfolio protection and stable cash flows than some other investor in their 20s. That older investor might go as high as half of their money in bonds, while younger investors will still want at least 5 or 10%. I would always hold something in bonds, though, not just for that protection from a crash, but just to take advantage of those lower prices when stocks do fall. Next on our bond ETF list is one we've talked about before and one of my favorites, the Global X Super Income Preferred ETF, ticker SPFF. Now, a preferred share is somewhere between stocks and bonds. It's not a debt obligation like a bond, but includes that fixed dividend payment that's higher than most stocks. Preferred shareholders get their dividend paid out before stockholders, so it's a little less risky, and most of these convert to a regular stock at a certain price. So preferred shares don't have quite the upside return as stocks, but do have those higher yields and the safety of bonds. Now, why I like this one is partly on that safety, but also because you get a higher return than most of the bond funds, so really the best of both worlds. The Global X Fund invests in 50 of the highest paying preferred shares and produces a 6.4% dividend yield against an expense ratio of just 0.6%, which is really good for one of these specialized ETFs. The fund does skew a little towards financials and bank stocks because those just happen to be the ones that pay the highest yields on their preferred shares. You've got a lot of the big bank names here, like Wells Fargo and JP Morgan, along with some of the smaller names like Ally Financial. And that said, this is going to be the most volatile of the group and breaking that rule of half the risk compared to the market. With a standard deviation of almost 17%, it's still less risky than stocks, but not as much as those true bond funds. I did want to include this one though because it's a great option for investors that want a little bit of both stocks and bonds. That bond-like part of the preferred shares has done its part this year, and not only has the fund outperformed the broader stock market index, but You can see it hasn't crashed lower either. So that idea of that lower volatility. I'll reveal my favorite bond ETF next, but I want to get your input on this as well. Now, I know stocks are the popular investment and they're always going to be the biggest part of your portfolio, but how much do you have in real estate and bonds? So scroll down and let me know what percentages of your portfolio is in these other two asset classes and why. My favorite bond fund is actually the lowest dividend yield of the group, but has beaten the market this year, protecting your money. The Invesco Senior Loan ETF, ticker BKLN. The fund holds more than 140 large institutional loans. Now, most of these are going to be those non-investment grades, which means they're going to be a little riskier, but do pay higher yields. Most loans are due within 5 years, which means they don't have quite the interest rate risk as you see with other bonds. So as rates rise, this bond fund won't lose quite as much. The dividend yield is lower on this one at just 3.4% because these are shorter term loans, but that volatility is also one of the lowest in the group, really helping to offset the risk from stocks in your portfolio. With fears of a recession and rising interest rates, the loans have taken a hit just like that high yield bond fund that we looked at, but with the eventual rebound in the economy, this one should produce a strong upside price return along with the dividend. Even on those higher rates though, and the recession fears, this one has held up extremely well, beating the stock market by more than 6% in the first half. Beyond that dividend yield, that's more than twice the market average. Click on the video to the right for the one real estate stock you need to buy. Round out your portfolio with a great asset class for cash flow and safety. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.